an ear pod in my ear. Patrick has
I have the other one.
We've got some clients here in the background and our team. So we'll go ahead and get started. Welcome in, everybody. Pat, if you want to join me up here.
Yeah, sure.
Everybody can see you. And we're just super excited today, Thursday, July 23rd, 2020, to have this town hall today introducing investments to Abich Financial firm. And this is something we've been talking about for a while now. I know it's extremely important. Pat and I started talking a couple of years ago, and the stars kind of aligned today or this year to bring Pat on board. Pat has 30 years of investment experience, managed $300 million with Goldman Sachs, spent a good bit of time with Merrill Lynch, Edelman Financial, and Fisher Investments. So he's been around the block, he knows what he's doing. He's got a wealth of experience and knowledge, and just going to be a great asset and a resource at the firm for our clients. So this town hall is specifically about investments and the offering that we're going to have available to our clients from here on out. Just a little bit of some insight as to what we think is going on in the market right now. I saw some red across CNBC and CNN Money today. Markets indexes most of the indexes were down. Apple was down. Microsoft was down 4% today. I'm pointing that out because we both believe that we're not out of the woods yet in 2020 with regards to the market. We believe kind of we're right in the middle of the storm, right? And we haven't gotten out of the storm yet. We saw a huge crash in March. You know, for years we've kind of been preaching that we're on a historic, amazing bull ride in the market. You know, an 11-year bull run in the market. Yeah. And at some point, what goes up must come down. Let's prepare for it. Let's prepare for it in advance, because we know it's healthy and normal for the markets to go up and down. They have to adjust and correct. There's nothing wrong with that, but let's prepare for it. And sure enough, in March, the worst downturn or fastest downturn in stock market history, just in 30 days. And then in April, one of the best months in stock market history. And today, most people are kind of back up to where they were before the downturn, and a lot of people are ahead, which is fantastic. Yep. Although a lot of times, most of the times, we're not down 30, up 30 back-to-back months. Usually when we're down 20, 30, 40%, it takes 2, 3, 4 years, sometimes longer, just to recoup those losses. Correct. Hence the lost decade from 2000 to 2012, during the tech bubble, and 2008 and 2009. In both of those segments there, the S&P was down 50%, and to recoup 50% losses takes time. And if you look at the average return, the average annual return from 2000 to 2012, the average was zero. There was no return, and that's why people call it the lost decade. So that's kind of our take on where the market is today. We're being cautiously optimistic, and again, we want to prepare for the worst and hope for the best, and get in front of everything that's happening. We've got an election this fall. We still don't have. Obviously, I think we're still pretty far away from a vaccine for COVID. A lot of people are saying maybe the middle of next year. Yep. And I don't think the market's going to fully recover until we actually do have a grasp on COVID and perhaps a vaccine or vaccines, and we're kind of, smooth sailing from there on out. So that's a little bit of a background on the current state of the market, kind of where we feel we are right now. I mentioned Pat's experience, and he's on board with the company right now. And Pat, I think at this point, I'll kind of turn it over to you.
All right, well, thank you. I can't thank you enough. And I'd like to start off by first just thanking everybody for attending today. I truly do appreciate you taking the time. I'd like to maybe divide off my section here, my presentation, maybe focus a little bit more on the background, what I'm bringing to the table here. I do want to focus maybe a little bit also on the current state of the economy, what happened in 2019, what's happening right now, and what we're really looking to forecast coming up down the road. I think it's also important to understand the new offering. We are going to be more of a full holistic, so not too many firms that you can go in and actually still have everything satisfied. So it is a full financial planning, full offerings are going to be available, and we are a fiduciary. That's extremely important, and I will bring that back up a little bit later on. And then I want to also pinpoint some more specifics as to how we're actually going to make our offerings available, some of the fee structures, and also some of our personal investment philosophy, which if you decided to onboard, that we're going to actually apply to your particular portfolio. Because we're not deviating from anything that has historically been done by Abe. Abe has built this. It is a fantastic offering. I spoke with Abe about 2 years ago, just really couldn't get the things working together, but it was, I would say, maybe an unusual confluence of events. And I can thank God for that things did come together, and we are really able now to offer what we believe is truly one of a best offering out there, at least in the northern DC area from what we can see. So maybe a little bit of background on myself. I have been in the industry for about 30 years. For those of you that are observant, that means I was about 9 years old when I started in the business, had a full head of hair. But I have started working for a firm that was actually a financial family office, a little bit different. It was affiliated with Goldman Sachs, primarily dealt with executives, entertainers, sports figures, things of that nature, and we ran the gamut. So we would do income taxes, estate planning, investments, insurance, you name it, it was done. And I spent a little over 13 years with that particular organization. And when you're with an organization that long, you're going to encounter various things. I was on the road about 120 days out of the year, met various types of people, managed assets, as Abe had alluded to. And that is still a philosophy that I bring to the table. When I was managing assets, it was predominantly for retirement folks, 55 to 75. That was the wheelhouse. And I would say about 60% of the assets were invested conservatively. But we're going back a number of years, and that's when we could utilize bond investments for conservative investments. But things have changed significantly. We'll talk a little bit about that when we get into the market stages. Did manage to go over to Merrill Lynch, spent a little time after moving into the DC area with Fisher, and then a little time with a firm that was bought by Edelman, Financial Engines. So very comfortable, understand what all of these folks do. I don't necessarily think that what they do is wrong, but I do believe that there are some improvements that could be made. That's really one of the reasons that when we built this, we decided not to go with a huge, brand name, corporate, type of entity. We wanted to be able to customize our portfolios a little bit more for the clients that we're working with. So we felt that that was really in your interest, and it also enabled us to lower fees in comparison to some of these other larger firms. Since we don't have that large footprint, we don't necessarily have to have all those expenses associated with that. So we did think that was a huge improvement for you. So let's just step back for a second and think about where we are with respect to the markets. I've had a number of folks I've sat in front of. A number of folks are holding Apple, Amazon. They're comfortable in the market. They feel like, oh, we went through a dip. We're now looking for, a V-shaped recovery. And my hopes, I am cautiously optimistic. I certainly hope that we go along that way. But looking in the rearview mirror, starting in September of 2019 is when we really did start to hit some bumps in the road. Some of you may recall, and I would suggest that you go out and Google this, there were problems in what's called the repo market. This is typically where banks are lending other banks' funds. There are some very liquid banks, and there are other banks that are not as liquid, and they will lend each other money. And it's what's called, in essence, the plumbing behind the economic system. And when you're lending money for such a short period of time, the interest rates are historically very low. What started happening, though, is that the demand for liquidity started going through the roof. And we had a problem when the repo markets actually topped out at an interest rate, overnight interest rate of a little over 10%. And that's when the Fed decided to get involved. They realized there was a massive liquidity need, and they started dumping cash into these marketplaces. Between September and the end of January of 2020, they dumped over $6 trillion into the wirehouses. That's before the first COVID case even came to the shores of the United States. So, also in that environment, we had an inversion of the yield curve. I always like to point out, a bond, simply put, a bond is an IOU. You're lending your money to the government, municipality, or corporation. As bond prices go up, yields come down. What happened is the 10-year Treasury yield came down to the point where it went below the 2-year Treasury. Why would that be happening? Because people were bidding the price up. Why? They were concerned about the future. That's why when you have an inversion of the yield curve, that is a recession indicator. So we did have some things happening at the latter part of 2019 that truly did tell us we are entering into a recession. Then when we had the COVID situation hit, it's almost as if we had a natural disaster occur at the beginning of a recession. So it's almost a twofer. Boom, boom. We really got hit. The market dropped, Fed stepped in, they added additional liquidity, and you have seen the national deficit has gone up significantly. We are now between 26 and $27 trillion in national debt. That's actually a staggering number when you consider it. And that all has to be part of the backdrop of what we're considering. We also do right now have the Federal Reserve putting its thumb on the scale, so to speak. They are actively out there, not only buying US Treasuries and putting them on the books, but also buying corporate bonds, high yield bonds. And they're doing so through BlackRock. You may have heard that name out there. So they are amassing loads and loads of debt onto their book. And you may have heard the term follow the Fed. There are a lot of folks who've decided to participate in these particular areas for the sake that if the Federal Reserve's buying them, they must be secure because they're given the backing of the federal government. And my first statement would be, all of these are cautionary notes. I always like to use the analogy that between 2009 and maybe the end of 2019, the longest running bull market in history, perhaps that was the eye of the storm. We went through the 2008 crisis. We entered into that storm. There was a lot of healing that should have taken place, but we put it to the side. Or more, I think the more apt analogy is we kicked the can down the road. Now we're here in 2020. We have the COVID. We have a number of other things occurring recessionary wise. We are putting debt through the roof. We are printing money off like it's going out of style. We do need to be very cautious looking forward. And I would say maybe for the next year, 2 years, 3 years. I do not anticipate this to be a full V and then just continue to have a rocket launch. To that point, if you're looking at the S&P 500 and stating, well, it seems like it's positive at least for the year, it's up about 5%. And the S&P 500, let's talk about that specifically, it's 500 stocks and they are weighted. Those larger companies are given a higher weighting than those smaller companies. The top 5 companies in the S&P 500, if we just isolate those, Microsoft, Amazon, Apple, Google, Facebook, they make up over 20% of the value of the S&P 500. Five out of 500 make up 20% of the value. Those 5 alone are up 35% year to date. So from January until now, up 35%. The S&P 500 is up 5. If we eliminate those 5 and we just look at the other 495 stocks in the S&P 500, the market's actually negative 2% year to date. I'm not happy about that, but this is the reality that we're dealing with. When I have somebody telling me, Pat, I think I'm going to ride it out, I think everything's going to be okay, the analogy I would use is I don't think it's a time to panic. I don't think anybody should be rushing for a lifeboat, but I do think prudently you should have some sort of exit strategy. And if you are between the ages of 55 and 75 and you are retired or you're planning on retiring, I think now is a prudent time to determine what's happening to those income resources that you're leaning on. We always talk about Social Security, pensions, other reliable sources of income. And then we may talk about some market-based assets, but we are still looking at all of the traditional assets that Abich Financial has always looked at. And I think it's so much more important in this environment to concentrate on what are those reliable sources of income. And if I am going to rely on the market to support additional assets or additional cash flow, how am I going to have those assets invested? So let's back off into exactly what we're doing. We have teamed up with TD Ameritrade, very well-known company. Another company not perhaps as well-known is J. Hagan Capital. That's the smaller firm that we're actually working with to help develop our specific portfolios, and they're actually going to help us with our algorithms. Why is that important? When we built our portfolios, we have concentrated on one thing first and foremost, and that is the risk associated with the portfolio, the bounce, okay? I like to use analogies a lot. If I were on two planes taking off at identical times from New York, going across the country and going to land in Los Angeles at exactly the same time. So exact same trip. But I could get on the flight that was going to be less turbulent, I would do it. I don't like turbulence personally. But so when you look at that, those are the types of portfolios that we're trying to construct. Those that can give you a reasonable rate of return without the volatility. That's the important part. When you go to a cocktail party, or even the one that we're holding here, semi today, it's great. It's sexy to talk about rate of return, kind of makes you feel like it's important, but it's the risk. That's the factor. The lowering of the risk that you should be concentrating on, especially as you enter into the retirement years. We cannot afford to take the dip and hope that it comes back up in time to pay the bills. We're not going to be doing that. We want to make sure that the bills are being met, your income needs are being met, and this is simply to supplement or complement any other income strategies that you have. So we are managing the risk. How are we doing it? We're building portfolios predominantly of funds, ETFs, exchange traded funds. Why? The costs are extremely cheap. The other thing that you'll recognize, names. BlackRock, I mentioned those already. Very famous out in the market. Vanguard, Fidelity, iShares. You'll see them all in our portfolios. But we are managing our portfolios tactically. That's another major difference. I've been with other firms, and again, I don't want to mention their names specifically, but they tend to put bumpers on their portfolios. And they only concentrate and maybe reallocate once every 3 months, 4 months, 5 months, depending on where it goes. And they will also, let's say the large cap area falls, they will immediately say, well, we need to build it back up. We need to put more money into large cap. Is that always necessarily the right thing to do? Just because it went down doesn't mean it's necessarily going to go back up. Maybe there is a different strategy that needs to take place. And that's where our tactical models are moving. We are looking at volatility factors, and I consider our portfolio to almost be, say, a basketball team or a hockey team. They're out on the floor, they're out on the ice, they're out playing the game, but we will pull a player and substitute somebody else in if we feel it's necessary. And we'll do it a few times during the month. We have no problem doing that because we are trying to control the volatility. And that's not something that can be done on a long-term basis. That's why we hired J. Hagan Capital to help us analyze those algorithms. And honestly, you don't want me looking at your portfolio every single day. We have other folks that are far better suited to do that. So we have them actually managing those. So that's specifically of what we're doing. We'd love to be able to have you come in, analyze your portfolio, especially in this environment. I think it is extremely important. Nobody sees the downturns coming until they've already happened. It's an unfortunate scenario. It's almost like climbing a hill in the middle of the night. You don't realize that you went over the peak until you look over your shoulder and you're like, it happened. And that may be too late. If you have excess funds, you're not worried about losses, that's fine. We're not built for everybody. I do not expect to have 30-year-old, or millennials coming into here wanting to buy the next hot thing. That's not what we're about. We build portfolios that are managed for risk. They're meant to complement the income streams. If you want to have a few things that may fall out of our portfolios, maybe you want a gold fund, or maybe you heard about a particular stock, we'll be more than happy to listen, and we can implement those types of plans. But we are trying to really stick with our models because we feel it's really the best suited thing for most folks in that retirement, environment. That's what we're looking to do. So,
wow.
Okay.
Can you tell everybody that's listening a little bit more about the fee structure?
Yeah.
I think you did a great job of explaining how the investment approach will complement our personal safety first approach and making sure. I always like to say, make sure the income, make sure the foundation of your retirement is set, and that's on strong, reliable, dependable, predictable income. Once the foundation of your home is built, I always say the walls, the roof, that can be replaced, right? The siding, the roof. We had a storm in Leesburg last year, and every single neighbor in our neighborhood had to have the roof replaced. Well, okay, that's 10 to 15 grand, but the foundation of the house is still fine.
Correct.
So once your income is fixed and it's set and it's dependable and it's coming into you in retirement, non-stock market dependent, great. All right, now let's talk about the rest of the pie. Let's talk about the rest of all of your monies, and are those being managed and invested to your risk tolerance to your goals, needs, and objectives. A good story is a couple who just came in from down south, Stafford, Woodbridge area, and they said they were conservative investors. And, you know, they're in their mid 50s and they can take a little more risk on than someone that's 65. However, they said they were conservative investors, and they sent us all their statements. Pat analyzed them. They're at Fidelity and Vanguard. They are 100% stock. 100%. No cash, no bonds, nothing else. 100% stock. Yet they believe they're conservative investors and they want to invest conservatively. And it wasn't until actually analyzing their statements that we found out, and they found out, hey, you're kind of not investing towards your needs, goals, and beliefs. Let's get this fixed.
And I think to that point, they were not in anything that I considered to be a poor investment. All of their investments, they were Vanguard, they were solid, they were low fees, they were everything that I would want to have in that particular investment. But it didn't fit what they said they wanted. They said they wanted something safe. They said they wanted something to get them through their retirement years. So they were shooting at a speed limit of 80 while telling us that they wanted to go about 50. We can't do it. All right. So we want to make sure that, great, it's a great product. Is that necessarily what you want? You know, I want a Ferrari. Fantastic. I can't afford a Ferrari, but that's the major point. But if I want to bring my family out, I'm not going to fit them all in the Ferrari. So what is it? Do you want a Ferrari or do you want the family vehicle? You can't have both. If somebody's like, Pat, I want something stable. I want something that's going to be able to support my income. I want to go to sleep at night. Well, if you're sitting there and you put everything into super high risk fund X, that's not necessarily going to fit the bill. All right. If you want to have some gambling money, fine. Carve off a piece of the portfolio that you have no problem gambling with. But understand, those monies that you've worked hard for, I don't manage money. Rarely have I met somebody who won the lottery. Rarely. Okay. Most everybody's worked hard. They've sacrificed. They've put the money away. They are hoping to get something out of this. And in turn, to take unnecessary risk with it because they heard something or they're parroting what's always been done, that's a big mistake. And what I would use, and you even use a true story right now, historically, 60% in the stocks, 40% in the bonds. That's what most people have done to get themselves through to their retirement years. 60-40, that's always been the split. Interest rates have plummeted. I used to manage bonds. I walked away from managing individual bonds because I could not give my clients what I could normally give them. Certainty of principal and a reasonable income stream. It was no longer possible. What you've heard is folks saying, well, instead of having 40 in the bonds, I'll move more into the stocks. I'll end up going to more dividend-oriented stocks, or I'll try to take some of the gains and maybe reap those to help supplement my income. Well, now you've just deviated your portfolio. At the time when you need income and you need safety the most, you have just increased your risk profile to a degree that you can't afford. That's not the answer. There are other products and other things available to you that you should be sitting with any advisor, us. We'd love to talk to you and make sure that you're doing it right. There are too many advisors out there that they feel like there is no other option because they only sell one thing. They only sell stocks, and that's what they're going to tell you to do. Because I have yet to meet a mutual fund manager, and I truly mean this, that has ever told anybody, now's the time to exit my portfolio. Sell, go to cash. It doesn't happen. That's your advisor's job. And that's why we've set our portfolios up to be very income oriented and following the algorithm so we reduce the level of risk on the part that is exposed to the stock market.
Well, one of my best friends is a wealth advisor at BB&T. They're telling all their clients, there is no other option. Matter of fact, they're telling them, Tina, there is no other option. Essentially, they're telling their clients, you need to be 100% stock-based, and that's just not right. That's not right for most people.
I find it unconscionable, very frankly. I really do.
Can you tell everybody about the fee structure, how we would get paid, how we would work together with our clients?
Yeah, our fee structure is very basic. It's a simple 1% fee. We feel that that's pretty much on average, you know, with what we see. And this is just on the stock side of the portfolio. There are some underlying fees as far as paying for the algorithm. ETFs, as I said, we're using those because we're trying to keep those costs low. But typically, not all of our clients are just going to be 100% in one area or 100% in the other area. We had an individual come in yesterday who was interested in the investment portion, but they were also doing some more income-based projects that were no fee whatsoever associated with them. So when we looked at their entire portfolio, all in, their fee structure came out to be about, I think it was 0.6% or so, which we feel is a very competitive and very reasonable fee. So again, we make the 1% on the assets under management on the stock side, but then on the insurance side or other income-based programs, that's something that we would discuss because they can deviate, but we try to look at all of the fee wrapped in an amalgamation, and we're trying to come in at far less than 1%. We think that's very fair for most folks.
Hopefully that helps explain the fee structure a little bit, and then we'll wrap it up right here and then open it up for questions and answers. One thing we would like to offer everybody, that's here in the office and listening to the webinar is a complimentary risk analysis of all your investment holdings, your IRAs, brokerage accounts, TSP, 401ks, IRAs. If you simply just send us the statements,
yep,
Pat can analyze them, put them into our risk analysis software, show you exactly what, the highest potential returns are likely to be, the highest potential losses are likely to be, what the fees and expenses are inside those funds and positions compared to maybe how we can help you. And the goal of hiring us or hiring any, retirement planner to help you manage your money is to get just as much of a return as you would, if not higher, with less risk. With less risk, and that's why Pat mentioned managing portfolios to risk, not for return. And so,
right. And we do also have some other features. I know there have been some folks have been looking for something a little bit different. We offer structured notes. I don't like to lead off with those. Those are some features where we can pay some fairly high interest, try to offer a little bit of stability, but that's something that we'd really have more of a one-on-one, type of discussion, because I consider it almost like the cherry on top. Again, we always want to start with the income base, start building out the walls, put the roof on, and maybe then just throw the cherry on top.
So we'll open it up for questions and answers. And again, wanted to make sure everybody heard that if you simply just send in your statements, we'll give you a complimentary risk analysis of your investment portfolio without charge.
So the first question is, so what do you provide back in the free assessment?
Great question. What do you provide back in the free assessment?
Okay, pretty much what it is, our portfolio analysis, we'll go through and actually enter any individual holdings that you had, be it mutual funds, ETFs, individual stocks. Then what we'll look for is it will give it almost a speed limit. We look at it for historically what its rate of return has been, what its standard deviation has been. And we can even go through what's called a heat map and kind of show you what sectors you're heavy in, what sectors you're light in. So it is also going to talk about diversification. If you wish, not only will we look at your particular portfolio and make comment as to how it's particularly arranged, but we'll also contrast it with any portfolio that we would make a proposal for. So then you could see, wow, my portfolio may have a height and maybe a higher rate of return potential of 28, but it also could lose potentially 18%. Our proposal, maybe it has a high of 24, but it only has a loss factor of maybe 12. Again, the whole idea is that we're probably going to get you to the same destination, but if we can do so with less risk, I think it's worth at least a moment of your time and consideration.
Your microphone is not working quite as well as Pat, so you might be better just speaking without it.
Okay.
Okay. We have a couple comments on that, but we have another one here.
Yeah.
If talking to almost retirees, would you want to specifically mention fixed index annuities that, along with Social Security benefits and the meager military pension, help me to sleep soundly without financial concerns?
Absolutely. And I mentioned my best friend working for BB&T Wealth, and them telling their clients the TINA acronym, right? There is no other option. That's what BB&T Wealth Advisors is telling their clients.
Yep.
You can't invest anywhere else. Don't invest anywhere else. The stock market and stocks and stock funds are going to be the only place where you can get yield and return. That's just simply not true and not smart or safe at all. So what we're using, and I think our clients know this, but our prospective clients may not, what we're using as an alternative oftentimes instead of any bonds as the bond alternative in your portfolio are fixed indexed annuities.
Correct.
Pat says they're the kissing cousin of bonds because look, we're not looking to light the world on fire with a bond return or a fixed index annuity return. Typically the returns and yield is in the 4 to 7 range, something like that, right? Where your stock portfolio long-term might be 7 to 10 or 6 to 10. But we're looking to complement the risk that you are taking in the market. You've got to have a safety buffer in there somewhere. And most importantly, if you need income in retirement on top of a pension, on top of Social Security, you don't want that income fluctuating every month. You want to know that income's coming into the mailbox every single month, no matter what the market's doing. So
if I could, I used to invest in individual bonds, and we typically would ladder them out of over a 10-year period. When I use the term ladder, a lot of people think, oh yeah, CDs, I used to ladder CDs. Exact same concept. What you would do is buy a 1 year, 2 year, 3 year, all the way up to about 10 years. And as the regular interest payments would come in, that was reliable. And every single year you would have about 10% of the principal coming due that you could either take or you could reinvest back into the portfolio. Therefore, you ended up with an average interest rate and almost a certainty of return of the principal, as long as the underlying bonds, were of decent quality. With interest rates down so low, that's really not the best idea at this standpoint. So we've had a lot of folks decide, maybe I'll go to a bond fund. Well, you could go to a bond fund. Maybe you'll get a yield of maybe 1.25 on a good day, but you're still going to have volatility of principal. I don't know when you're going to necessarily need that out. So that's where I am more than happy to introduce a fixed indexed annuity, mainly for the fact that it is giving me stability of principal. It is offering a reasonable interest rate. It is offering periodic liquidity if I need it. And most important, it's a guaranteed income. And that's really what I'm always looking for. Income first, then we can talk about the higher rate of return, but we need to make sure the bills are paid.
great question.
Right, we have, how are you accounting in the algorithm for COVID?
Well, COVID itself, it is part of the volatility factors. So it's not as if we have a COVID element in the algorithm, we have a volatility factor. So the fact that we went down 33% back in March, that's factored in. So it is something where we are looking in the rearview mirror and saying, what are historic volatility factors? So I would say by looking at, and I think maybe a good appropriate way to see it is the volatility index, the VIX. You can see how that has gone up and down. By looking in history, that is built in. So by seeing those factors and other factors built in, yes, we are taking COVID in. It's just not called the COVID factor. It's just called a volatility factor.
No other questions right now.
Okay. Any questions from our attendees here? All right.
Okay.
Any other questions? We'll just give it another minute or two.
Are those portfolios going to be part of my monthly income, or is it going to be left to grow?
What Pat and I have been saying lately to our clients is the money you guys have saved for your retirement is either going to be for lifestyle, what you're going to enjoy during your lives, or legacy.
Correct.
Or a combo of both. So to answer your question, are these portfolios going to be part of my monthly income or left to grow? Again, we want to build the foundation of the retirement home on strong, predictable, reliable income. We don't want that income that you really need to depend on in retirement with much fluctuation, with much wiggle at all. So then once the income is figured out, the rest is going to be invested according to what you want to accomplish over the rest of your life. You want to pass money on to your kids and grandkids, charities, and et cetera,
yeah. or
use some of that extra funds for extra trips and extra spending.
Yeah, income, inheritance, different way of putting lifestyle, legacy, same difference. And it's really, that's what you've accumulated the funds for. You're either going to use them during your life or they're going to be passed along to somebody else to use during their life. That's the point. So when you say, should those be part of my income stream? They can be, but that's also a personal preference. I don't come to the table to implement my plan. I come to the table to listen to what your needs are and implement the best plan to get you to your goals. If I have somebody who's extremely aggressive and can take the volatility in the market, as long as they understand that, that would be the type of plan that I would implement. But for the most part, most of the clients that we're meeting with have limited sources of income. They're looking for something a little bit more reliable. So we do try to use that combo. So we have been using our core portfolios, not so much for income, but for more growth that people can dip into if they need. But if somebody wanted to use it for income, we'd be more than happy to do that. But that's a very personal question, and it's not something that we're going to come to the table. This isn't the Pat plan. This is your plan.
one last comment saying they can't wait till our first Fridays come back.
We can't wait either. We kind of have a hybrid thing going on right now, but we can't wait either for you guys to come back to your second home here in our office and greet you with open arms. So hopefully this town hall has been beneficial, informational, timely. Hopefully it has given you guys some insight as to how we can potentially work together with you on the rest of your portfolio and how we can bridge what we've done with you already with the investments that you have as well to complement each other. So we hope it's been beneficial for you.
Thank you. Really do appreciate you taking the time this evening.
One last thing I'll mention again, if you would like a complimentary risk analysis, just send us your statements. You can send them to info@abichfinancial.com. info@abichfinancial.com. We'll get your statements and we'll put them through our risk analysis planning software, Pat will, and then we'll just set up a time, phone, video, or in person, to go over those with you and share with you how we might be able to help you with those positions. And again, show you an apples to apples comparison with how you're invested now in the market versus how we can potentially help you.
All right. Thank you.
Have a great rest of your Thursday evening.
And don't worry about the market.
Don't worry about it. Stay cool.